Well, thank you for those that have attended so far today. My name is Malcolm Horn, and Kim Kennedy's here with us, and we're both financial consultants with Alliant Credit Union. It's a common question. Hey, are you employed by the credit union?
Oh,
And yes, we are. We're part of the Retirement and Investment Services division of the credit union. We are located in Denver, Colorado, but with offices in DTC and Lakewood, and for everyone that's attending from another state, we do virtual meetings. And anybody that lives in Colorado, if you'd rather do a virtual meeting, we are happy to do so. Today's webinar is going to be on Social Security. It's going to be very educational, things that we think are very important that you need to be aware of when it comes to Social Security. At the end of today's presentation, we are going to answer questions. So if you would put that in the Q&A or the chat box, and we'll get those answered. Over the next week, we are going to kind of touch base with everyone. Again, making sure we're answering your questions when it comes to Social Security. Now, we want to make sure you're aware of some upcoming webinars that we're doing. We have the good, the bad, and the ugly when it comes to annuities. Again, it's going to be an educational webinar on annuities. Annuities have changed a lot. And even though some people might come in and say, you should not do an annuity, well, sometimes annuities might make sense. And so it's worth attending this webinar just to understand the good, the bad, and the ugly when it comes to annuities. Next one after that, we're going to be digging into something called IRMA, income related monthly adjustment amount, that has to do with Medicare and the premiums you pay. Some people are not aware that your Medicare Part B and D premium are going to be much higher depending on what your income is. So we want to, again, make sure you're aware of those when it comes to Irma, Aunt Irma, I call her. Anyways, we also have, we are not the only ones that do webinars. There are other financial consultants that provide webinars. Feel free to check those out, attend any of those. We also produce a podcast on various financial topics. You can find that on our website. And then, of course, our website has a lot of different financial information for you to learn more on if you want to learn more on a specific financial topic. So, with that, I'm going to pass it off to Kim, and she will jump into the nuts and bolts of Social Security.
great.
Thank you.
Thanks, Malcolm. Let me get set up here. Move all the right things out of the way. Okay, well, welcome everybody, and thanks for joining us. So this is about Social Security, and these are the questions that we think baby boomers want to know. Will Social Security be there for you? You've heard forever that it's going broke, and it's now your turn to collect, and you need to know if that's true. How much can you expect to receive? Well, part of determining when to retire is to understand your income and expenses, right? So you need to know what your Social Security benefit's going to look like. When should you apply? You can apply as early as 62 or as late as age 70, and we'll shed some light on those different claiming ages. How can you maximize your benefits? There's not a lot of options left except wait, but there's a couple. We'll walk you through those. And then lastly, will Social Security be enough to live on in retirement? And I'm sure some people will be able to do it, but it was never intended to be a 100% income replacement in retirement. So the first thing we need to do is understand the value of Social Security. A lot of people will say, hey, it's not much, I'm not even going to worry about it. Well, contrary to popular belief, it is a major source of guaranteed lifetime income for most Americans. In a lot of cases, it's 40% of your income in retirement. And retirement has changed, right? It used to be, if you look at the triangle on the left, the good old days, you'd work for a company for 30 years and walk out with a gold watch and a big fat pension. And then you had Social Security on top of that. And then your nest egg, what you saved, was kind of icing on the cake. Well, today that triangle is completely flipped upside down. Not many companies are offering pensions. And if you have one, consider yourself lucky. So that makes the decision you make around Social Security even more important. And then the reliance on the money that you've saved in 401ks, 403bs, and IRAs, very important. Social Security does offer an income that you can't outlive. So, for example, if your monthly benefit is $2,000 and you live 10 more years, you will have pulled out over 260,000 in benefits from the system. And if you live 30 years, you'll pull out 973,000 plus in benefits. And I get it, the dollar doesn't buy what it used to for sure, but that's still almost $1 million and it's still a good chunk of change. And why is it important that it lasts as long as we do? Is because we're living longer. A man that makes it to age 65 has about a 50% chance of living to normal life expectancy of 87 and a 25% chance of making it to age 93. And ladies, it's no big secret that we live a little bit longer. We have a 50% chance of making it to 89 and a 25% chance of making it to 96. And if you're a couple, at least one of you has a 50% chance of making it to 93 and one of you a 25% chance of making it to 98. And you may think that seems impossible, but I had a grandmother that lived to be 5 weeks before she turned 101. One of our colleagues had an aunt that was still living in her house with a little bit of help at 103. So it does happen. And think about that for a minute. If you retire in your mid 60s and you live to your early to mid 90s, that's 25 to 30 years. That's roughly a third of your life that your money needs to last in retirement. So making a good decision about Social Security is really important. And Social Security does offer annual inflation adjustments. You know, I mentioned corporate pensions. If you have one of those, consider yourself lucky. Most of those are flat, meaning whatever amount you get never changes. Well, Social Security does add cost of living adjustments. So, for example, if your benefit is $2,000 a month today, in 10 years, that will be 2,438. And in 30 years, you can see it's just over 3,600. And the way they calculate that increase each year, it's called COLA, cost of living adjustment. They use the CPIW metric. That's the Consumer Price Index for urban wage earners. And then they just take that amount and increase the benefits for those receiving Social Security, but also for those not receiving Social Security as of yet. So you'll see that on your statement each year if you're not yet collecting. So here's kind of a historical look of the cost of living adjustments. And you can see, look at 2010, 11, the zeros after the financial crisis. And then I always like to point out, 2022 and 23 when we had the hyperinflation and you see those increases of 5.9 and 8.7. This year, it was 2.8. So anybody receiving Social Security this year got a 2.8% raise over what they were getting last year. These numbers come out in the fall and go into effect the following January. I've been reading that they think it's going to be 2.7, 2.8, and now all of a sudden I read something yesterday with the spike of energy prices, it might be 4.2. I mean, it's a little early. We don't know what it's going to be. It doesn't happen till October, November, so we've got some time to wait and see what that will be. So looking at a 2.8 adjustment, on $1,000, the increase is $28. So you're getting $1,028 a month. But look, the bigger the benefit is, then the dollars begin to matter a little bit. Obviously, it's a percentage, but at 3,000, it's 3,084, and at $4,000, you're getting 112 more. So it's important because our expenses go up every year, right? Nothing ever stays the same. It always costs more. And Social Security kind of has some built-in life insurance. This is an example of spouses. The man has a $2,000 benefit. The woman has a $1,200 benefit. When one spouse dies, the surviving spouse gets to keep the higher of the two benefits, not both, but at least the higher of the two. Certainly it's gender neutral, but at least it's something to be aware of that in this scenario, if he passed away, she would get his 2,000 as a survivor benefit the rest of her life. Will Social Security be there for you? No, there's a lot of people worried about it, and there is a lot of stuff in the press about it's going absolutely completely broke in 6 years, and it is drawing down, but it's clearly not completely broke. So let's take a look at the trust fund. So this was last year's numbers. So you can see the income was 1.449 trillion. That's payroll taxes that we all pay in through our paychecks to Social Security. That's interest that's earned on the special issue securities inside the trust fund, less expenditures of 1.609 trillion. That's payments being paid out. So you can see last year there was a decrease of 229 billion in the trust fund. It's generally been a pay as you go, right? So what comes in goes out. But if you look at this next chart, on the far left, the green is the revenue coming in. The blue line are the benefits that are paid out. So you can see back to 1980, we had more revenue coming in than benefits paying out. And then you can see that surplus kind of has built up over those years when we were bringing more in than we were paying out. And you can see right about 2021 is when the benefits being paid out is kind of beginning to exceed what money we're bringing in. So you can see this dark blue, we're going to absorb all of that surplus. And if they don't make changes by 2032, the system there won't be enough in the trust fund to pay 100% of the promised benefits. It would drop down to 81%. So it's not completely 100% insolvent, but clearly nobody wants a 19-20% cut in their benefits either. And now all of a sudden, since 2032 is only 6 short years away, we're starting to hear people talk about it, right? It's always been a kick it down the can, kick it down the can. Well, now it's here. So let me give you an idea of some of the things that they're kicking around to help restore 100% solvency. One, eliminate the taxable max on earnings. So some people aren't even aware of this, but every year there's a number that if you once you earn that amount, you no longer pay into Social Security. This year, it's when you make 184,500. From that point forward, you don't pay into Social Security. So if they reduced or if they removed that cap and had every dollar earned pay into Social Security, that would cover 100% of the shortfall. Number two, raise the tax on earnings. So right now, we as employees pay 6.2% of our paycheck, while our employer also pays 6.2% of our paycheck into Social Security. If they raise that by 1%, meaning the employee pays 0.5% more and the employer pays 0.5% more, that would cover half of the shortfall. And they're talking about raising the normal retirement age. You probably know people in your life that it was 65 and 66 and now 67. If you were born in 1960 or after, our kids or grandkids might have to work till 69 or 70 to get their Social Security. That change would cover 1/3 of that shortfall. And number four, change the formula, right? I mean, as longevity numbers change each year and people are living longer, they might make a change to that formula in which how they calculate our Social Security benefits. And the other thing they're kicking around is that how they calculate that cost of living adjustment each year. I told you it was based on the CPIW. They're looking at something based on what they call the chain CPI that has to do with behavior spending, right? If prices escalate on one thing, we as consumers will buy something else. And there's a metric that goes along with that, and that what that would end up generating relative to Social Security is a lower annual increase. So for people that are in the baby boomer years, I mean, we think you're going to get what's promised to you with, a potential adjustment to your cost of living adjustment each year. But otherwise, we think if they do it, they'll probably push it on our kids and certainly the higher earners if they're still working. So, kind of key point number one for today is that Social Security is an inflation protected income. You've paid in the premium every paycheck, so be smart about how you collect it. How much can you expect to receive? Well, the amount of your Social Security benefit is going to depend on two things. Number one, how much you earned over your working career. And number two, how old you are when you decide to turn your benefit on. So here's what Social Security does. They take all of your earnings, historical earnings, and they index them forward for inflation. So everything's in current today's dollars. Then they take the highest 35 years and then they do an average. They come up with a monthly average of those 35 years. And I say highest 35 years. It's not the contiguous 10 or the most recent 5. It's just wherever in your earnings history after adjusted for inflation, they pick the highest 35. And then they take that monthly average and they run it through a formula that has three levels. And the bottom line of that is your primary insurance amount. This is the amount you would receive from Social Security if you took it at your full retirement age. And from there, they just add the cost of living each year. So let's look at an example. So somebody who earned that maximum Social Security earnings each year, remember I said that you stop paying tax at a certain amount, somebody who earned that max each year since 1922, or since they were age 22, their AIM or average index monthly earnings would be $14,358. That's the highest AIM that anyone could have this year. So here's the formula. So they take the first $1,286 of that and multiply it by 90%. The next 64.63 by 32%, and then the remainder by 15%. And then they add that up. So you could see that in 2026, the highest full retirement age Social Security benefit that anybody can have this year is $4,216. So some of you may have heard or think that they're thinking about means testing our benefits. You know, the more you make, the less you get. Well, if you look at this formula, they already do that. Here's what I mean. Let's say you were a lower wage earner your whole career. If you look at the first line of that formula, you're getting a 90% replacement of that income into your benefit. If you go down the line in that formula, the more you make, the less of an income replacement you're getting into your Social Security benefit. And then here's another chart that shows it also. If you earn 50 grand most of your career, a year, you're going to get about 45% of that replaced as your Social Security benefit. If you jump over to someone who made 150 grand most of their career, you're only getting a 27% replacement of your income as your Social Security benefit. So it's already means tested. So how to estimate your benefit? Clearly, you don't have to go through that calculation that I just showed you. There's a few ways. Probably the best way I would say is if you were to go create an account on socialsecurity.gov/my-account, you can pull up your statement and look at it anytime you want. They've really revamped that website. There's a little slide rule that says, well, if I took it at 63 or I took it at 65 or 68 and a half, it's really dynamic and you can just slide and take a look. It's very easy to view. The My Account is also just a really good place for information. My husband's on Social Security. I've looked at his account many times. You can see when your Social Security check is coming. You can see the deductions for your Medicare Part B. You can see if you're having taxes taken out. You can change your direct deposit bank information. You can order a replacement Medicare card. You can update your address. I mean, it's for a government website, I thought they did a really great job. So same thing, there's the retirement estimators, that slide rule. The other thing that is not on their particular My Account website is there are some calculators on this benefit calculator planning section of the Social Security website. And why is that important? So let's say you're somebody who your full retirement age is 67, you're going to retire at 62, but you're going to live on cash or IRAs and wait until 67 before you turn on your Social Security. What's unique about these calculators is you can go in there and say, okay, if I do that and I have, from age 63 to 67, my income is 0, you can put zeros in for those years and see what the impact to your benefit is if you do that. And that's important because if you were to look at your Social Security statement and you see the last earnings year and amount that's reported on that statement, that is the income amount that is used. They assume you're going to earn that amount until you turn full retirement age. So that's kind of built into that calculation on your statement. The other thing I'll say about the statements, I talked about cost of living and all of that. I mean, if you're looking at it today, it only has cost of living adjustments up until today. So if you're doing any future planning, make sure you add that COLA to that amount. This just gives you a breakdown of the full retirement age based on year of birth. So if you were born in 1943 to 1954, your full retirement age is 66. If you were born in 1960 or after, your full retirement age is 67. Excuse me. And if you were born between 55 and 59, you can see it's 66 and some months. And this is what I would expect they would do if they raise the full retirement age to 68 or 69 is they'd kind of stagger it like they did here, getting us from 66 to 67. So what about if you apply early for Social Security? Early means any time before your full retirement age. If you do that, your benefit will be reduced. So if your full retirement age is 66, you can turn it on as early as 62, but it's a 25% reduction. And if your full retirement age is 67 and you turn it on at 62, it's even a little worse. You're going to get a 30% reduction. And you can see the closer you get to your full retirement age, the amount of the reduction is less. So also, we usually get a question, does this mean I have to apply at 63 or at 64? And no. And all these reductions are prorated, for 63 and a half or 63 and 8 months or whatever. So that you can do it by month in between those ages. I kind of make a big deal about saying if you apply early, it's reduced and it's permanently reduced. And I do that because there's a place on the Social Security website that reads as if you turn it on early, yeah, you get less, but once you have full retirement age, it pops back up and you get the full amount. And that is not true. So they should work on the wording. But so once you turn it on early, that's kind of what you're going to get based on your own benefit. The other thing that can happen, and you want to just be aware of it, if you plan to turn it on early and still work, you're subject to something that's called the annual earnings test. And basically what that is if you turn your benefit on before full retirement age and work, for every $2 you earn over $24,480, they will withhold $1 from your Social Security benefit. Notice I said withhold. All those withheld dollars get thrown into a basket, and then once you turn full retirement age, they get thrown back in and your benefits readjusted. But it's interesting. Easy math. If somebody earned 3 times that, maybe 75,000, 100% of the benefit would be withheld. So we see people often that want to retire early and, hey, I can get this much from Social Security and I can work part-time and I can earn this much and my expenses are covered, only to realize they didn't know about this earnings test. So just be aware of it. I'm not trying to discourage it. Just be aware of it as you go through your planning. And if you want to avoid this earnings test altogether, if you wait until full retirement age or after to turn on your benefit and still choose to work, they won't withhold $1. You can earn as much as you want and still collect your full Social Security. No problems from Social Security. Clearly, you'll be paying tax on all that, but they will not withhold anything from your benefit. And if you decide to wait and apply for Social Security after your full retirement age, you earn something called a delayed credit, and it's pretty good. It's an 8% simple increase for each year you wait. So if your full retirement age is 66 and you wait till 68, that's 8% times 2. It's a 16% simple interest increase to your benefit. And if you're 67 is your full retirement age and you wait till 68, you're going to get 108% of that full retirement age amount. And in addition, those cost of living adjustments, the 2% or whatever it is, 2 point something percent, that's on top of the 8. So call it a 10% increase for each year you wait. And I realize the market, of late has certainly done better than 10%, but this is a guarantee, as far as the rules go today anyway. Something to think about. This chart is just designed to give you a quick picture view of claiming early or claiming late. The top half is if your full retirement age is 66, the bottom 67. So on the 67, you can see to the right, you can delay up to 70 and get an 8% each year. So you get 124%, and you can see what the carve backs or the reductions are if you decide to turn it on early. So just an easy point of reference. So this is a break-even chart, and normally people think about a break-even chart of, well, if I turn it on to 60, they want to beat the system, right? So if you look at this, the orange line is a person who took their benefit at 62, got a 25% reduction, versus somebody whose full retirement age was 66. The break-even between those two decisions is age 78. Meaning, if you believe you have a reasonable chance of living beyond age 78, you would pull more money out of the Social Security system by waiting till 66 instead of 62. Okay, traditional break even. Same analysis between 66 and 70, the green line, that break even is 82 and a half. So again, same comment. If you believe you have a reasonable chance of living beyond 82 and a half, cumulatively, you'll pull more money out of the system if you wait till 70. Now, people always say, well, I just want to get the most out of the system. And, when do you know if you beat the system, right? If you go to the right of this chart and you're 99 and you're on your deathbed and you took it at 70, you can say, yeah, I stuck it to the man. I pulled the most money out of the system as I possibly could. So another way to kind of put a spin on this break-even analysis is maybe not so much did you stick it to the man out here on your deathbed, how much are the checks that are coming in your mid to late 80s when you really need it for, healthcare or prescriptions or whatever the case may be. So maybe that's a better, or at least a different way to think about it, right? None of us know how long we're going to live. We're all just kind of taking a guess with that. Okay, so key point number 2, your monthly benefit will be reduced if you claim early. Other things that can reduce your benefit that people don't always think of is you can elect to have taxes taken out of your Social Security. And once you're on Medicare, they will automatically take your Part B premium out of your Social Security. And then if you did take it early and you decided to work and that annual earnings test kind of hits you, they might withhold money if you make too much and go over that annual earnings test threshold. Let's talk a little bit about spousal benefits. So when Social Security was instituted years ago, most married women didn't work. So to provide financial security for women in their old age, Social Security came up with spousal benefits. Now, these are gender neutral, doesn't really matter, but So what a spousal benefit is it's equivalent to 1/2 of the primary worker's benefit if it started at full retirement age. So let's look at this example. In this case, John's benefit is $2,000 and Jane did work, but her benefit is only $800. If Jane applies at her full retirement age, she'll get half of John's because $1,000 is more than $800. So that's how that works. Again, gender neutral. Here's some of the rules. In order for Jane to access John's benefit, John must have filed. So the primary worker must have filed. And the spouse, Jane, in this example, needs to be full retirement age to get a full spousal benefit, which is 50%. She can apply as early as 62, again, if John's filed. But if she does it at 62, she's only going to get 35%. And you know those nice 8% delayed credits that I spoke about on our own benefits? Those do not apply to spousal benefits. Well, I'm already widowed or divorced, so how does that impact my Social Security claiming strategy? Well, there's something out there with Social Security called divorce spousal benefits, and it works the same way as spousal benefits do if you were married for at least 10 years, the person trying to get the divorced spouse benefits is still unmarried, the ex needs to be at least age 62, and if the divorce was more than 2 years ago, then the ex-spouse doesn't need to have filed. You could imagine in a divorce situation that somebody wouldn't file just for spite, so the ex couldn't have access to the benefit. Well, Social Security figured that out, and they said, look, as long as the divorce was at least 2 years in the past, that requirement doesn't need to be there. So here's some rules that go along with divorce spouse benefits. More than one ex can receive benefits from the same worker's record. Benefits paid to one ex-spouse do not affect those paid to the worker, the current spouse, or other exes. So let me just give you a little visual of all that. Let's say Bob was married 3 times. Each of those marriages lasted 10 years. Each of them ended up in a divorce. Bob's benefit is $2,000. Ex-wife number 1 goes to get divorce spousal benefits. She's not married. Boom, she's getting half of Bob's at $1,000. Same thing with ex-wife number 2. She's not married. She's getting $1,000. And ex-wife number 3, same thing. She's getting $1,000. And let's say Bob the Charmer is currently married and has a wife, and she, as a spousal benefit, is also getting $1,000. So it's not a pie that's divided up across the exes. They are each getting that same amount. And I think probably when Social Security came up with these rules, divorces weren't as prevalent, and clearly not multiple divorces as prevalent as we see today. And divorced spouse benefits stop upon getting remarried, because then you'd be entitled to collecting spousal benefits, right? Maybe that's a new dating thing, right? You can check out and make sure they whip out their statement and make sure you're getting a step up in spousal benefits if you go down that path. Just kidding, just kidding. Okay, let's talk about survivor benefits. I touched on this a little bit in the beginning about what happens if in a couple situation and one spouse dies. Well, here's an example. If the spouse dies while both are receiving benefits, the widow or widower may switch to the higher amount. So Joe and Julie are married. Both are over full retirement age. Joe's getting $3,600. Julie's getting $1,500. Joe dies. So Julie tells Social Security that Joe's died, and her $1,500 benefit goes away, and she begins receiving Joe's $3,600 a month benefit as her survivor benefit that she will get for the rest of her life. The only thing that's probably not true on this slide is these days, Julie wouldn't be notifying Social Security. The hospital, the hospice, the mortuary, they're like Johnny on the spot notifying Social Security, because they'll always take back one check, right? And they don't want things to go on for months. So that they've really tightened that up. So by the time Julie gets around to calling them, they probably already know. So here's another example of survivors. This is when delayed claiming's involved. So again, Joe and Julie, Joe's full retirement amount is 3,600, but he decided to wait till 70. So instead of 3,600, he's getting 4,464 bucks. Then he dies. So Julie will get what Joe was getting as long as she's at least full retirement age. So she would get that 4,464 as her survivor benefit. So here's some rules with survivor benefits. The couple must have been married at least 9 months prior to the date of death. The survivor must be at least 60 for a reduced benefit or full retirement age for a full benefit. So in the example with Julie, if she's full retirement age, she would get that 4,464. If she asks for the survivor benefit early, she's going to get less. And the survivor benefit is not available if the widow or widower remarries before age 60, meaning they figure that's young enough that you'll be able to get the benefits from your second spouse. Now, if that marriage ends, then that person could go back and get that survivor benefit. And divorced spouse survivor benefits are available if the marriage lasted at least 10 years. So remember Bob and his 3 ex-wives and wife number 4. If Bob kicks the bucket, all those ladies just doubled their money and now they're all pulling in $2,000 a month. So the rules around survivor benefits, or the calculation, I should say, around survivor benefits is probably the most convoluted area within Social Security, but it basically depends on 2 things. One, the age at which the deceased spouse originally claimed his benefit. So how old was Joe when he claimed his benefit? If he died, if he claimed before full retirement age, the survivor will be limited to the higher of the benefit he was getting at death or 82.5% of his full retirement age amount. If the deceased claimed after full retirement age, like Joe did, then the survivor will get whatever he was getting. That's my example of Julie getting Joe's 4,464. And the second piece of it depends on the age at which the widow claims the survivor benefit. So if the survivor claims before full retirement age, then it's going to be reduced. You can see anywhere from 71.5% of that full retirement age benefit if she claims it at 60, she or he, and then it goes up from there. If the survivor waits till she is full retirement age or after, then the benefit's going to be 100% of what the deceased spouse was receiving. So we realize this is very convoluted. If you're in this situation or need help calculating that, Malcolm and I are happy to help you run through those numbers and go through that process. So earlier, I made a comment that if you take Social Security early, you're stuck with that early reduced benefit forever. Well, the only place in Social Security where that is not true is with survivor benefits. So if you claim a survivor benefit before you are full retirement age, that does not affect your own benefit. And a lot of people do it that way. Let's say I'm 65 and my husband passed away, so I could get his benefit as a survivor and let mine grow, maybe with those delayed credits, and turn that on at age 70, right? So it all depends on how the dollars work and what your situation is. But it is true that claiming survivor benefits don't impact your own. Key point number 3, if you're widowed or divorced, you may be eligible for survivor benefits, divorced spouse benefits, or divorce survivor benefits. It could make your check bigger. Malcolm and I used to do these webinars as seminars face-to-face in different areas around town, and we did one, and we had a gal in there one night that was in this situation and realized that she could have been getting more money for 3 years. So, again, it's always good to check. When should you apply for Social Security? Well, there's a lot of things to consider about when to apply. One, are you healthy? Two, how long do you think you're going to live? Do you need the money, right? If your health is terrible, and you can't work anymore, well, then take it early. You need the money, right? Number four, whether or not you plan to work, that really has to do with if you're thinking about taking it early, but you're also going to work, just remember that annual earnings test. Maybe it doesn't make sense for you to take it early. And lastly, your survivor needs, right? I mean, if you're the highest wage earner and you just want to get out and take it early, but you might have the lowest life expectancy, maybe that doesn't make sense. Maybe you want to leave your spouse with a higher benefit if possible. So why would you think about delaying benefits? Well, clearly you get a bigger check to start. And let's take a look at the impact of this with COLA. So if you if your full retirement age is 67 and you took a benefit at 62, you're only going to get 70% of that. So let's say that that's $2,100. But if you waited until full retirement age, you'd get 100% of that. So instead of getting $2,100 a month, you'd get $3,000 a month. But don't forget, let's also add the cost of living on it. So it's really $3,312 a month. And then lastly, if you could wait all the way to age 70, that first check with COLA is $4,359. So definitely the COLAs definitely magnify the impact of your check. So why else may you want to delay your benefits? Well, could be more income later on. So let's look at this chart. Let's take the top line. If you claimed your benefit at age 62 and you're now age 70, you've been getting checks for 8 years, and at 70 that check is $2,460. If you claimed at 67 and you're now 70, you've been getting checks for 3 years and it's just over $3,500. If you claimed at 70, your first check is $4,359. Let's say all three of these people live 15 more years. So if you drop down to age 85, now the guy that started at 62 is bringing in $3,311 a month. The person that started at 67 is bringing in $4,731 a month. But the person that waited till 70 is bringing in almost $5,900 a month, not double the person that started at 62, but almost, right? So it definitely matters the longer you live, right? How can you maximize your benefits? Well, the first thing to do is to take a look at your statement. And when you go onto that website, there's a place where you can click and look at all your historical earnings. Make sure it looks accurate. I mean, mistakes are pretty rare, but if you're self-employed, we see a little more mistakes there. So it doesn't take long to just kind of look back through your years and see if it seems reasonable. Look for missing years. We had a gal come through our office, and somewhere in the midst of her work history, she had a couple years where it showed zero earnings, which prompted the question, hey, did you take a couple years off? Were you in school? Were you staying home with kids? And she says, no, I've always worked. I've always paid into Social Security. Well, come to find out, she was working for a company that was taking Social Security out of paychecks but not sending it to Social Security. Obviously a big no-no, and some people went to jail, and most everybody's records got fixed except this gal. So, 6 months of going back and forth between Social Security and the IRS, we finally got her fixed. But it's a quick check, just make sure. And then lastly, this is probably the one that is the most plausible for people, because the other ones probably aren't going to happen, is can you improve it by working longer? So remember I said that your benefit is based on your highest 35 years of earnings. Well, if you look at your record and you only have 32 years of earnings, guess what they put in for those missing 3 years? A zero. So 3 zeros in a simple average is going to wreak havoc on the amount of your benefit. So clearly you want to get rid of any zeros, so maybe you need to work a year or two more. And if you don't have any zeros in your record, working a little longer will replace some of those low earning years, right? So just something to play around with. And again, you can go to those benefit calculators and say, well, if I work, you can key in all your annual historical earnings. And then you can say, well, if I work this many more years and make this much money, how much does that change my benefit? Because it'll knock off those lower years. All right, applying for Social Security at the optimal time. I mean, just because your neighbor put in an application at 62 doesn't mean you should. There's some statistic out there that about 40% of the people apply for 62. If you need it, do it. But don't forget to consider your income now and in the future. I think people sometimes say, yeah, I want out. I hate my job. I can get Social Security at 62. These are my bills. I'm good. But what about the future? Did you put inflation on your expenses? Did you plan for any unexpected expenses? Just look at it in context of now and the future. And your life expectancy and your spouse's life expectancy. Coordinating spousal benefits. As I mentioned, there's not a lot of ways to strategize. They took a lot of that away a while back, but here's a couple that still make sense. The first one we just call the maximization strategy. And this is where the lower earning spouse's benefit is more than half of the higher spouse's benefit. In this case, the strategy would be both of you delay to age 70. And what this does is it maximizes lifetime benefits over average or long life expectancies. The hybrid strategy, this is where the lower earning spouse's benefit is less than half of the higher earning spouse's. So the logic here would be the lower earning spouse claims early and the higher earning spouse claims at 70. It generates income sooner, right? You'll get some money early from the spouse that claims early while still maximizing and protecting that higher benefit amount that would cover both people, meaning it would become a survivor benefit at some point in the future. Okay, so kind of key points again. If you apply early, your benefit starts lower and stays lower. Cost of living adjustments definitely magnify the impact of taking early or taking late. And certainly the longer you live, the more beneficial it is to delay. If we only had a crystal ball or birth certificates had expiration dates, we would know that, right? Your benefit may be taxed and reduced to cover Medicare premiums. So, again, just know that what you think you're going to get may not be what you net based on the deductions that come out. And don't let the earnings test discourage you from working. Just be aware of it when you're putting your plan together, if that's something that you're trying to build into your plan. And delaying benefits would give the surviving spouse more income after you're gone. So let's talk a little bit about taxes. Some people are surprised to know or angry to know that they tax our Social Security benefits. So let's take a look at how that works. So to determine the taxation on your Social Security, they look at something called provisional income. So down at the bottom of the screen, the definition of provisional income is your adjusted gross income. So salary, rental income, pension income, dividends, cap gains, plus 1/2 of your Social Security benefit, plus tax exempt interest. So if you own muni bonds, if you add up all of that stuff, then you take it to this provisional income column, the middle column on this spreadsheet. If you're married filing joint and all that stuff adds up to over $44,000, you've just triggered the maximum taxation on your Social Security. And what that is 85% It's not an 85% tax. It means 85% of your total Social Security benefit that you receive for the year is subject to tax. It just lands on your 1040 and you pay whatever your ordinary income tax rate is. And if you're single, you can see it only has to add up to 34,000 before you trigger that highest level of tax at 85%. So these levels of taxation, the 50%, I think that came in the mid 80s, and the 85% was in the early 90s. And the problem with it back then, these are the same numbers, right? So they've never adjusted these for inflation. So back then it probably wasn't impacting that many people. Now it's hard to stay below these thresholds, and some people do, but it's hard to stay below. So it's like this big mousetrap that you get caught. And if you don't get caught right away when you retire, by the time you turn on required minimum distributions and you have more taxable income coming in, boom, you're there. Okay, people always want to know what's not included in provisional income. So the things that are excluded are Roth IRA distributions, non-taxable pensions and annuities, qualified charitable distributions. If you're 70 and a half and you want to give away money out of your IRA directly to a charity, you do not pay tax on that. Inheritance, life insurance proceeds, qualified medical distributions from health savings accounts. None of those are included in your provisional income. So ways to minimize taxes on Social Security, it's kind of hard. Those brackets are pretty low. Here's a couple ideas for you. If you have investments that are generating income that you don't need, you can reduce that by repositioning those into tax-advantaged investments, not muni bonds. While they do give you tax-free interest, as far as Social Security taxation is concerned, you have to add that back in. So what we'd be talking about here would be something like cash value life insurance or a non-qualified deferred annuity, where you can get that money out of your taxable income or provisional income category. Think about your IRA required minimum distributions. They're going to put you most likely in a higher tax bracket. So think of all the years that we put money in pre-tax 401ks, traditional IRAs, 403bs, with this great advantage to not pay tax on it, but compound it tax deferred with the idea that we pull it out in retirement at a lower tax bracket. Well, boom, if you're 73 or 75, those are the two ages that you have to start taking money out of those accounts that haven't been taxed yet. 73 if you were born in the 50s, and if it's 1960 or after, 75 is the year you've got to begin that process. So maybe it makes sense to begin thinking about those RMDs and maybe spending down some of that IRA money and waiting to turn on Social Security, right? Convert your traditional IRA to a Roth IRA. Malcolm and I love Roth IRAs. I mean, if you're 59 and a half and you've had a Roth open for 5 years, all the earnings and interest come out tax-free. So think about if you were able to have your retirement plan be one big fat Roth IRA in your Social Security, what would your taxes be in retirement? Zero, right? Now, sounds great. I'm not saying run out and convert a $500,000 IRA to a Roth IRA today, because if you do that, you're paying tax on $500,000 in the year that you do that conversion. So it's not an all or nothing. Some people, we help them structure it in a way that, yeah, I'm willing to convert, up to the 24% tax bracket. You clearly don't want to be doing Roth conversions when you're earning, a big salary, but maybe there's a window, right? Of you're working part-time, or you're working less, or you're not working and you have other money to live on, cash, and you've got a number of years before Social Security, or you have Social Security, but you have a number of years before your RMDs start, right? We look for low income years to do Roth conversions. Delay Social Security, that reduces the number of years the benefits are subject to tax. And certainly if you delay Social Security and you're going to get a higher amount, remember the taxation is only 85%. So more of that 15% number that's not taxable would be higher. Reduce expenses and continue to manage taxes throughout retirement. So kind of the same points. Social Security offers an inflation protected income that you can't outlive. It includes benefits from your survivor. If you take things early, your benefit's going to be reduced. Couples should always maximize the higher earner benefits for the surviving spouse. I don't like statements that say always. I mean, both Malcolm and I have clearly run into couples that they both have great Social Security benefits. They both have pensions. They have bunches of money in 401ks. It doesn't always make sense to wait till 70. Maybe it makes sense to take Social Security, maybe on time. And that way, if something does happen to them, there's more money in their accounts that pass on to their kids, right? So I just don't like always statements. We like to run each scenario independently and see what makes sense. If you're widowed or divorced, you might be able to increase your benefits. So what we want you to take away today is please don't consider the decision about when to take Social Security in a vacuum. Look at it in context of all the other things that are going on. Pensions, IRAs, 401ks, RMDs, investment portfolio. Are you planning to work, right? If you think about retirement, you're trying to build this puzzle, right? And put all these pieces together. Well, this is a piece of it. And we understand that you have questions clearly just about Social Security, right? When should you apply? What if you want to keep working? What if you already applied? How much will your benefit be? How to coordinate? What's your best long-term strategy? And what do you do next? Well, Malcolm and I offer a complimentary planning process. We call it a discovery session. And I'm going to just show you kind of a sample of one of our plans. So this is Richard and Deborah. They're both 62. Richard is going to retire at 67. He thinks his life expectancy is only 85. Deborah's going to retire at 65, and she thinks she might live till 95. They've got some savings. They each have some money in a 401k. They're both contributing the maximum to their 401k and getting a 3% match from their employer. They each earn 150. You can see the Social Security benefits. Richard at 67, his is going to be about 41,000 a year. Deborah's going to take hers early at 65. You could see her benefits about 35,000. Richard has a pension that's about 9,500 a year. Then we put in all the expenses. So the living expenses, that's 60 grand a year. That means they want 5,000 a month after tax in their pocket to just cover their basic living expenses. We add an inflation factor to this number. We know expenses continually go up. In addition to the basic expenses, they've got healthcare costs. We break that out. We believe absolutely we got to use a higher inflation rate on healthcare costs. And they want to do some traveling. So we put some travel in there with, again, a different inflation factor, and maybe just front load the retirement where they might travel for the first 5 or 10 years. So here's their cash flow. So what this is telling you, the red line that goes across the screen is the planned expenses that I just walked through. How we're covering those expenses is determined by the color of the bar. So if you go all the way to the left where it says 2025, you can see for 3 years, that teal blue is both of them working. Then that drops down because Deborah retires. And then she turns on her Social Security in navy blue. And then in 2 more years, you can see 2030, that's when Richard retires. And he turns on his pension, that's the mint green. So Social Security in blue and the mint green pension covers almost all of their expenses. You can see the yellow, that would mean they need to withdraw some money from somewhere. And then you jump out a few years and you see the orange, and that's when those RMDs start. So they're going to have more money coming in from required minimum distributions than they have planned expenses. So they can choose to, spend that. They can choose to maybe do some Roth conversions ahead of time. They can choose to give it away. They can choose a lot of different things. So if it works exactly like this, at 95, there'd be about 2.4 million left for Deborah to pass on to their heirs. From a tax bracket perspective, you can see the blue line is 24%, so they're staying underneath that throughout retirement. But notice, like right when Richard retires at 2030 up until the RMD age, they're paying, in essence, no taxes. Those are great years for Roth conversions. So what if? One thing that's really great about our software is we can model all kinds of what ifs. If you can dream it, we can do it, so to speak. So let's say Richard says, well, what if I decided to delay my Social Security until age 70? Is that a good thing? So we've run that scenario and we've laid it on top of him taken at full retirement age. So you can see right about when he retires, this little gray bar, that's basically saying that if he delays till age 70, then there'll be less money in their portfolio at 67. Well, of course, they haven't turned on Social Security. So year by year, less money, less money, less money. Boom. So when you see green, that's kind of that break even where it switches over to say you'd have more money in the portfolio. It doesn't happen until he's 80, right? So that's kind of a long time to wait to see a benefit just based on Richard. And if he did that, he'd also have, 241,000 more in his portfolio. Yeah, and again, 240,000 over, 30 years isn't, or 20 years isn't all that big of a number either. But what other benefits could they gain by doing this? Well, they would increase the survivor benefit for Deborah, right? If he waited till 70 and then passed away, she would at least get that higher amount. More of their income would be tax advantaged, right? Because 85% of Social Security is subject to tax. And by waiting till 70, that meant that he was spending, or they were spending down IRA money while they wait. So that reduced their RMD. So maybe that orange RMD income was now more in line with their overall spending. So that's a way to reduce RMDs in the future. And if you think about that, if you believe that taxes in the future may be higher than they are today, maybe it does make sense to pull out some of that IRA money and pay taxes now while they're quote unquote lower. Well, let's do a different what if. What if Richard decided he wanted to retire early at the end of this year and turn on Social Security at 63? Is that a possibility? Well, there's a lot of gray here. You can see that it costs them about $1 million, but let's go back to their cash flow. So it's still very doable, right? Instead of, he has, 1.3 million left at Deborah's age 95. So it's $1 million less they're given to the kids, but maybe that's okay, right? If he's got some health issues and he wants to retire younger and they want to do some traveling while they're able, maybe that makes sense. But at least you've got the data to make the decision, right? So what we're trying to get across today is that Social Security is too important for guesswork. You work pretty hard to get what you have and to get your benefit where it is. Don't guess. Put together a plan and do some what ifing based on your situation and make the best decision for you that you can. So I have one analogy for you, and then we'll jump on to questions. And the analogy is the concept of retirement income planning as it compares to mountain climbing. So if you're a mountain climber, right, when you're getting ready for the climb, you're training, you're gathering your gear, there's planning, there's preparation, all of that stuff to be successful. And if you're trying to prepare for retirement, what are we doing? We're saving in our 401ks, we're saving in our IRAs, we're getting our kids through college, we're paying off our cars, we're paying off credit cards, we're trying to pay down our house or pay it off. And voila, we get to the top. Now what? Now we have to come down the mountain. Well, in mountain climbing, you could slip, you could trip. I think the guides that take people up Mount Everest say more deaths occur on the way down than on the way up. So, what about during retirement? What kinds of things can happen to us that could derail our retirement? So, lots of things that could throw a wrench in our retirement. Clearly, hopefully, not all of these come all of our ways, but Malcolm and I do try to stress test the plan. We'll model higher rates of inflation, healthcare and on expenses. We can model what happens if a spouse passes early. We can model what if you have a long term care event. Unplanned expenses. I've had several clients in the last few years come to me and say, I need to take out money to, my daughter's getting divorced. I need $20,000 to help her with a lawyer, or my kid's going to rehab. I need money to help them. So, we can model things like that. So we try to put all those pieces together and help you put together the most bulletproof retirement plan that we can come up with. So we're here to help. We certainly can answer your Social Security questions. We can help you come up with a retirement withdrawal strategy. A lot of people get to retirement, they say, well, which money should I spend first? What account should I touch? We can help you decide if it makes sense in your situation to spend your IRA money down and defer taking Social Security till a later date. We can help you look at your employer plan and understand your rollover options. Create an efficient Roth conversion plan. Is it X amount per year? What are the years? Is it up to a certain tax bracket? We can help you see the best long-term strategy for your situation. And if it makes sense for you to move your retirement money, we can help you do it in a way that avoids any mistakes, right? We don't want you to pay taxes on it. We want you to move it in the right way, and certainly help you with beneficiaries if needed. So that is what we have today. And I think Malcolm's going to come back on and put on a poll. Let me find my camera here.
Yes, I will.
Okay, I'm flipping mine on and off by mistake. So
Sorry about
all
that.
right.
The poll that we're gonna put out there is, if you'd like to schedule a meeting with one of us, please let us know, and we'll make sure to reach out to you. We're gonna reach out to everybody anyways, but if you'd like us to kind of reach out, let us know.